All right, Crazy Market Slide. You know you love him, Mike McGlone. It's senior commodity strategist at Bloomberg Intelligence. You've all been asking all about all the futures markets. I know I've been getting the phone calls, and we have the best here on the business. So, Mike, how are you on a Friday, man?
I'm good, Steve, and I appreciate coming back on. I hope we can make this a regular because Friday afternoon, I think, is the most important time to make relevant decisions in markets for the next week. And Friday's closes have been my entire career. I've always looked at the weeklies, and Friday's market close is always the most important in my view.
Yeah, I agree with that. And does it different for you though because Monday is a holiday? Are you worried about that?
No, not really, because cryptos are open, and
Okay.
it's one of the things we'll be watching this weekend. Is that Bitcoin market has to stay above 64,000. That's my line in the sand. I would call that a speed bump for support. It's really good support. It's basically the mode from 2024, which was the most significant year ever for putting a peak in cryptos. It's got to stay above that level. And I think at some point it's going to break below it. So I'm just watching for signals, and maybe it gets up to 74. But that's what I'll be watching this week and see how cryptos, if they can still stay above that 64 level. I remember it was a few months ago we were knocking on the door of 94 on a Sunday night, and 94 was significant because it marked unchanged from the end of 2024. And once we broke down through 94, it was hitting stops down to 60. So what's the next step?
Right, and if it hits 94,000, I think I'll have a pretty good Valentine's week. I'll be happy with that one for a long time. So let's get to it. A couple things I want to ask. I'll throw them out at you. I don't do gotcha questions. It's not my thing. But cocoa prices, low, 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 low. Sugar, low, 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 low. What's going on?
Well, I appreciate you going there. I used to watch sugar very closely and cocoa very closely. I wrote a lot about cocoa. The thing I want to point about cocoa is it and orange juice were the
Yeah.
worst performing commodities in 2025. Why? Number one reason, as we learned in trading, is because they were the best performing commodities the year before. And that's how it works. Even silver, I mean, even sugar. I just remember a few years ago, we had these major deficit issues and problems in India, and they always cycle, particularly for the elastic commodities. The least elastic commodity, which isn't really a commodity is gold, but it faces what cocoa faced too, is they just went up too much this year. And one thing that's really elastic that I think still people haven't, and market hasn't figured out yet, that's going to cause a lot of pain, and that's the devil's metal. Silver almost always goes down because it went up too much, and this year it went up too much.
It did. And I know you had some charts to get to. I'm gonna
Yeah.
get out of your hair a little bit and bring it to the stage. And you.
Yeah, let me just run you through a few charts. I have a macro-based case that's going to tilt over. I tell you what I'm going to tell you, and that is, I think the best trade this year, next big trade is U.S. Treasury long bonds. So I start with the leading indicator for all risk assets, and that's Bitcoin. Bitcoin has just simply reverted to its mode, the most widely traded price since the beginning of 2024. That's $64,000. That's a great level to look to test longs, to if you're short, to just respond. I think eventually it's going to go through it. But the thing is, I want to point out is all that's really happening this week, the most significant factor this week is the S&P 500 is down about 1%. If that's flowing over, that's all that matters. So on this chart, I just show Bitcoin overlaid on the same scale with S&P 500, just multiplied by 10. But they're both hovering right around that 69 level in terms of the few handle. I think the key thing to think about is Bitcoin's a leading indicator. It's breaking down. And if it continues to break down, it's going to pull everything long. And certainly if beta breaks down, Bitcoin's one of the key things to focus too. And similar copper. Copper's on the same scale as the S&P 500. If you take the per pounds price of copper and on the same scale as the S&P 500, just lop off a couple zeros, you got the same price. Except now copper's been lagging the S&P 500 since 2023. It used to be the same chart. The same chart was copper and S&P 500. And my point is, copper has a good potential. I think it was a worthy short, still is, anything above 6, because it's lagging beta. And if beta drops, it's probably going to drop back down to its mean again since 2024 is right around 4.5. Same thing in crude oil. If you look at crude oil overlaid with this S&P 500 times 100, it's still everything's subject to beta going down. Now, the thing about crude oil is since 2019, the most significant price is right around 70. It's the lock-in price, and we're hovering below that. So the signal is it's rejecting that mean mode and potentially heading lower. I think it's heading towards 40. There's a deflationary force, and the number one thing on everything that matters is here's good old beta, S&P 500. Is it rolling over? If it is, it is all that matters. If beta rolls over, S&P 500 rolls over, that's all that matters. And I want to show you one key indicator that it might be. And if it does, it's going back to 6,000. Why 6,000? It's nothing other than, we used to call it the high volume price. Where do we trade the most? The most traded price since 2024. It's right around 6,000. It looks like it's peaked around 7,000. And one key reason for it to go lower and continue rolling over is just S&P 500 180-day volatility is buried. It's near an 8-year low. If we end the year here, it'll be the lowest year end since 2018. And I just want to point out why I see deflationary forces. I published this today, and I really enjoyed publishing this you look at CPI. It's hovering below 3%, and it looks like if you just look at the past 20 years, it's always bottom around 1%. My prediction is CPA will go to 0% potentially this year. And one key little reason for that to happen is just a little backup in the S&P 500. You take the S&P 500, divide by GDP, it's 2.2 times. It's the highest in 100-year. Just a little backup on that, and CPI is dropping to 0. And I think I'll get to that next big trade, and that's bonds. I want to point out another thing. Here's the key thing I'm also completely worried about is you just take the price of gold divided by this S&P, divided by commodities, the Bloomberg Commodity Index. It's the highest ever. On the chart I show you, the Bloomberg Commodity Index divided by gold, it's the lowest ever. Just, that's not a place to be buying gold. So what I'm worried about is when beta backs up, which might be starting, everything is going to go down, including gold. Why? Because it just went up way too much. So just getting towards the end, I want to get to my key files there. And also the metals. The metals have been the best performers. It's my favorite index. This is Bloomberg All Metals Index. In fact, the index team created it because I asked them to. Because if you want to invest in all commodities, you stick with the metals. But now, if you take metals versus broad commodities, it's the highest yet ever. And the stretch is very similar to when they peaked in 2020. So I look at the metals is very similar to cryptos last year. Up too much, massive speculation. Everybody's jumping on a board. People like us, rational investors, say, yeah, maybe we should sell. So I'm finishing my last 2 slides to get to my key point. One thing that's been an enduring trend for a while, if you take the mass of the entire U.S. Treasury complex from T-bills out to T-bonds and measure that on an index, we have that in the terminal. Just say if you invest only in treasuries, if you divide by gold, the price of overall treasuries, that yield is the highest, so the actual price of treasuries is the lowest in almost 50 years, Steve. It's like, okay, I'm looking for something that just a catalyst to prove to me that you're supposed to be selling gold and buying treasuries, which I think is the next big trade. So treasuries are very cheap historically, almost 50 years. Bitcoin looks like it's rolling over. And then here's one key factor again. If you take that S&P 500 divided by GDP, it's the highest in 100 years. And I'll end with this chart. One of my key things I used to love using as a trader, an ex-trader, is how when markets get really compressed, you want to trade an option to break out. What you mentioned about cocoa earlier, cocoa was super compressed in 2024. All my signals were bullish. My strategist in London wrote a bullish comment. We put it out and it jumped almost 10x. Didn't happen overnight, but it took a while. Same things happen in good old U.S. Treasury bonds. See this chart right here? This is US1. I started in this trading pit in 1908. The Bollinger Bands, the 100-week Bollinger Bands on the U.S. Treasury bond future are the narrowest since 2008. That market's ready for a breakout, and this is why I tweak over to his, well, how cheap are treasuries? Well, they're cheapest versus gold in 50 years. So to me, that's the next big trade.
So when you say that the cheapest in 50 years, that spread, how would you play this? Are we buying treasuries here? I mean, 4.6 bothers me a little bit.
Yeah, it should. Well, so I look at and to me, when you have these kind of signals, you want to go out and farthest. Typically, historically, the farthest on the curve as you possibly can. U.S. Treasury long bonds or zeros. I mean, I've traded zeros for decades. Key thing, Steve, to put this in context, I remember hopping in that car in the van with a bunch of my colleagues from our New York office and driving to the Chicago office right after 9/11 because we had to do the job, and I was the only one in that vehicle who was feeling comfortable because I was way overweight. Good old treasury bonds, zeros. So to me, that's the trade. And so I look at it so far, you look at that long bond. The long bond keeps trying to bump up against 5%. The high for this year so far is 4.95. The high last year is 5.15. And both of those highs came right about the same time Bitcoin peaked and tried to make new highs. See the connection there? Bitcoin's a leading indicator for all inflation and deflation, and it's deflating. So I think simplistically that long bond right now about 4.7% has peaked around 5% for the year. Then it's going to drop towards 3%. And there's one key catalyst for that. The number one force of deflation in the entire world is just that good old U.S. stock market starting with, gosh help us. Remember the days we used to have 10% corrections?
Yeah, I do. I remember sitting in those chairs at 500 points down and going, what the hell's going on today? I totally remember that. We got a question already asking you right now from Docport. It says he wants to buy gold, but I think it's very elevated right now.
Yeah, I agree. Let's put it this way: the way editors have said I have to write it, new longs and gold right now have a very poor history of outperformance. So what I look at right now, the most conviction is, first of all, gold's cousin silver, leveraged gold, or some people call it the devil's metal. I think, I viewed 100 in silver as a worthy short. Now it's easy to say. How you do it, it's a little bit more difficult. I used to structure positions to do that, and I think it's going back to 50. Similar with gold. Gold, I think it's much more likely to go to 4,000 than stay above, than go to 6,000. It might touch 6,000, but historically, what's happened in gold, silver, and the metals this year typically can put in highs for decades. The last good example of how we rallied at this velocity was when gold first reached $850 in 1980. It's the last time we were 60, more than 2 times its 60-month moving average. Inflation peaked around 15% then. Right now, it's dropped down to 2.4%. So gold is just silly expensive. And if you weren't lucky enough to be on that trade before, you never want to chase an asset like this after it goes up. So I would say, and I'll end with this, as a trader, this year my strategy was to come in completely nimble and look to be responsive, i.e., because I fully expect stock market volatility I showed you earlier to go up and to be responsive. And I think the responsive thing to be thinking in gold is maybe look for responsive bids around 4,000 and maybe in silver around 50,000. If you don't get a chance, stay away. Because it's one of those markets, as volatility picks up, there'll be a lot of chances to do a lot of responsive trading with price and time on your side. And right here, it's just a horrible place to be buying gold historically.
Okay, I love that. I love that answer. Okay, well, let's talk about the long bond and the ultra bond here. The big question around both of those is not the bond itself, but the question mark is around housing. Right now, the home sellers are now outnumbering buyers by over 530,000. And we're also hearing that the 30-year now is very close to the lowest level since August of 2022. Is this it? I mean, wages are rising, housing affordability is coming up. Is this good news for everybody?
No, what is happening, I think, is we've reached the end game of classic example of post-inflation deflation. So there's a number of books. I'll mention one book was called The Price of Time by Edward Chancellor, and just point out all cycles in history of excessive liquidity and asset pumps always are followed by the reciprocal deflation. Now that's happening in China very clearly, led by the housing market. It very much happened in housing inequities in Japan for basically the last 30 years. And it's just a matter of time it trickles over to the the 10 on a scale 1 to 10 on a global basis, almost ever, of elevated assets, and that's the U.S. stock market. To me, that's everything for my view that the long bond is going to be the next big trade. If stock market stays elevated, which I show here, there's not a lot of reason for inflation to go down for long bonds, but we just have normal reversion in the stock market, potentially led by Bitcoin, what is the cheapest treasury prices in almost 50 years. I mean, just compared to China, you're looking at on our the next largest country, and even Japan, our 10-year notes 4%, they have 2% handles. Even most of Europe are 2% handles. So when people talk about selling treasuries, I'm like, well, they already have. It's the deepest market on the planet. It's the safest market on the planet, and you're getting to double the basis points in returns. It's just, that to me is my point is, and there's one key thing. So basically, I look at treasury long bonds are basically a put on the stock market, but this put returned almost 7% last year, despite the fact that the stock market went up 17%. I will propose to you, if we were to drop 17%, these long bonds will go up 30%.
I agree with that. And you know what? It's interesting behind that is when we talked about the CPI print this morning, not nearly as bad as I thought it was. Market goes back up, but that affects the those guys over there on the other side of Washington D.C. at the Fed. They've been screaming and crying and saying that inflation, but yet inflation seems to be in check. What do you think is going to happen? Are we gonna get a cut here? Is this going to make everybody happy?
The number one reason to cut is stock market going down. Right now, it's very reluctant cutting because they know the lessons. Every Fed governor knows the lessons of adding alcohol to the punch bowl when the party's
Right.
getting out of hand. And the party is out of hand. We show that with stock market is just on a tear. Just a little normal reversion here. Just think of this, Stephen. If we drop 10%, that's almost 25% of GDP. I shouldn't say if, when we do. That's the most in 100 years. So
Yeah.
I think, and even our economists are starting to say the wealth effect really was, despite the wealth effect, retail sales were weak, but the wealth affects everything. But this is my point: is when you reach this high stock market cap to GDP, and inflation CPI cannot get above 3%. Now that's a good sign. Of course, the numbers could be, there could be a little hand on the scale now. We have to be is concerned about that, given our new president and him pushing back on data he doesn't like. The bottom line is just look at the patterns of history. It's pattern recognition. CPI has dropped at or below 0% for 3 times since 2009. That's almost the exact same that crude oil dropped around 40%. But every single time it dropped, we had our stock market's cap to GDP at much lower levels. I mean, the big time when it dropped down to minus 2% was when stock market cap to GDP dropped down to half a percent. Now we're at 2.2, 2.3 times. It is the economy. And that's why I look at alternatives. Cryptos were a great alternative until they blew out last year. Precious metals and gold were the great alternatives. I think they've blown out this year, and that's why I think there's only one left, T-bonds. And that thing is, for T-bonds to be wrong, that stock market has to keep going up at the high, at the greatest, most expensive levels ever. And I think what's going to happen is what Trump did to cryptos. They got trumped. Stocks are going to get trumped too. There's just way too much enthusiasm that this wonderful administrations can make them. It's just a fact. And just look at the stretched levels. This is the thing about this. Do you want to put new longs on here? I mean, people are doing it, but we all know that's responsive trading means you don't really overweight risk assets at the highest levels in 100 years.
Right. And the second carrier is now in the Gulf now with Iran.
Yeah,
are you worried about oil prices? I mean, oil prices are getting fairly depressed at $63 a barrel on WTI. Looks like North Sea Brent is not much higher than that anymore. There's not much of a spread anymore. Are you worried about oil prices just exploding if something happens, if kicks off in Iran?
No, but that kind of fear is what's ideal for the producers. What's happening in oils, I show you in your chart. This is a bear market. If you look at since 2019, that's so important because it was before the distortions of 2020, the COVID, and then Russia's invasion of Ukraine in 2022. What that did is it sparked a normal up too much cycle that has to find a low price cure. Last 3 times since 2008, it's been around 40. The key thing to remember about oil, it's way oversupplied. And what's shifted is the world has shifted to the Western Hemisphere, led by the U.S., has shifted from price maker to price taker. Every time you hear about OPEC, my check mark, thank you very much. The U.S., all the Western producers see that little rally and they sell forward. And you can see that in backwardation. And then they bring on that supply. So spiking prices means more supply, lower prices. So here I just point out, I think crude oil is on its way to 40. I think if producers are lucky, I've been saying that for 3 years. Admit it. I've been wrong, but I see the cycle. It's just, and it's one key thing has been missing is just the drawdown in the stock market that stays down a little while. 20% that stays down a couple of years. God help us. Stuff that used to happen. That's severe deflation. But the problem is it's already a deflating asset. Overhang with the S&P 500, you can see the risk. And so if there's some kind of major issue in the Middle East that pumps prices on near 65 or 70, that's going to just bring on more supply. It'd probably be temporary. The producers get a chance to sell forward, and they're bringing on now lots more supply. See the cycle there? So I'm not worried. Even the key thing I'll end with, the key thing also from an end, and number one, oh, by the way, what does Mr. Trump want for the midterms? He wants and needs lower energy prices. Now, we've seen what he's willing to do for that with what happened in Venezuela. And the key market this year is natural gas. And we've had the coldest winter. I mean, the Hudson almost froze over. First time would have been 1934. My son just came from D.C. He said the Potomac was frozen over. The coldest winter maybe in 100 years. Yet natural gas is at $3.25. You go out to the January contract, it's only $5. It can't go higher. Number one, because every time it gets above 5 or 4, the producers bring on more supply.
That's right.
And demand gets curtailed a little bit. And also,
you're not worried about Ukraine? You're not worried about nat gas coming out of Europe at all?
I'll mention that too. And what is the vested interest of the U.S. government, certainly the president, is lower prices. The key thing about Ukraine is, okay, now it could get worse. If we wake up one morning, we hear about the word fallout. Now that's about as bad as it can get. But the key thing is, what's the next step potentially that's going to highest risk for natural gas and gold is a little bit of detente. Say if we have a pretty serious ceasefire that lasts, market's going to start pricing for that natural gas and that energy to come on. I mean, it's been sort of curtailed for some time. Imagine if there's some kind of coup in there, great, and that could easily pressure, crude oil right to my 40 level and gold back to 4,000. There's a pretty significant geopolitical premium, most notably in gold. Crude oil is more just an oversupplied market. And who's leading that? Who's the price maker in crude oil? It is now the US, Canada, Guyana, Brazil, Argentina, Venezuela. You see the trend there?
I do. Mike, you're getting a question asked here from a guy named Joe. He says, Mike, what do you think about tether gold?
Oh, I love that concept of what Tether's doing. I'm glad you brought in Tether. Number one thing about Tether, it's the most enduring bull market in cryptos. 2018, picture this, I'm in Hong Kong. There's a crypto bear market. I arrived right after a typhoon, and I just pointed out everything was in a bear market except for one thing. Tether's market cap was $2 billion. I said, it's going up. Why? Because it is going up. And why? It's everybody in Hong Kong told me, Mike, this is the first time in history we and the mainland people have been able to access currency outside of our system. We can get to the dollar. It's revolutionary. The key thing about Tether now, though, is it's going to flip in Ether. Right now, Tether's around 185 billion. Ethereum is just around 250. Tether has flipped into everything so far. Enduring trends. What's going to make that trend stop? It's flipping to everything. It's how important that technology. And I do suspect maybe at some point it's going to flip in Bitcoin and be the number one crypto. Why is that not profound? Because it's been flipping in everything. And the bottom line is it shows how awesome the technology is. But the key thing it points out is this is once the Trump administration embraced stable coins or crypto dollars and realized, oh, by the way, they invest in US treasuries. Why push back on that? We realized that whole concept of peer-to-peer cash from Bitcoin was not needed. And we also found out that what was in the past a way to get away from the system from cryptocurrencies and Bitcoin was ruined by the Trump administration getting involved and now being heavily invested. And that's why I love you mentioned, but Tether Gold is just another way to get exposure to gold, and gold's expensive. But bottom line is they're taking some of that money, investing in gold. But I think it's potentially signs of a peak in price because they should have been buying around 2,000, and buying around 5,000 is probably not a good idea.
I love this. Folks, listen, do me a favor. Click on x.com. Go to his Twitter page, Mike McGlone 11. Please give him a follow over there. This is awesome. And to answer your question, Mike, yes, you're here every week on a Friday, my man. I'm not letting you go. You're my guy for commodities. I love this, and we love Bloomberg. And what we love more than anything is the insights that we're getting, so that we have smarter people here. And I love that. Joseph, thank you as well, Mike. Appreciate that. All right, from all of us here at Quasar Markets and Bloomberg, we love you guys. We'll see you next time. See you next week, Mike.
Thank you, Steve.